Okay, so this is Intermediate Accounting 3, 4123. Obviously, you've taken Intermediate Accounting 1 and 2, which is why you're finishing the last section. I assume you guys finished chapter 18 was the last chapter you did in Intermediate Accounting 2, correct? I believe this is what chapter 18 was the last one you would have done, because here we start off in chapter 19. It should be the last chapters left in the book, which is 19, 20, 21, 22, 23, and 24.
But the last chapter, I guess that we didn't cover the last chapter.
Let's see.
So we're gonna be using the same book.
Same book, which is, I believe you guys have the 16th edition, right? Okay, yeah, same book. So the way I run my class is on Tuesdays, and I apologize for the confusion with the schedule. I believe you guys were all under the impression that we had the class yesterday. Originally it was scheduled for yesterday, and there was a change last minute. I don't think they updated it in your portal. So it will be on Tuesdays, the class. I will be here every Tuesday lecturing on each chapter for the week. Every week you will have a quiz and a homework assignment due. I'm pretty lenient with due dates, but for the most part, I like everything done by the end of the day on Sunday of that week for that chapter. Obviously, if you have an issue, just send me an email. Like I said, I'm pretty lenient. My goal is, for everyone to pass in the class and learn at the same time. The quizzes will be about 10 to 15 questions. It will be online through Blackboard. We'll have one midterm and one final. Your midterm will cover the first 3 weeks of class, and your final will cover the last 3 weeks of class. So it's not going to be cumulative of everything. I will randomly post discussion questions on the Blackboard. Those will be for extra credit. So if you answer them, I give you 5 points for the week. You just have to answer the question. You don't need to respond to anyone else. At the end, I will total up all the extra points that you get, and I will apply it to your lowest points, wherever it gives you the most benefit to apply it to. If it's your midterm, final, homework assignments, I'll apply it there. My lectures don't usually go 3 hours because I can cover 1 hour, one chapter in about an hour and a half to 2 hours. I do stay here to the end of class. So if you have any questions, you want to do the homework, or you have questions on the homework, I stay till 9 o'clock at night. So you're more than welcome to ask me whatever questions you have. I'm also usually here an hour before class. So if you have any questions, you want to catch me before class, just feel free to come in. What else? So today we're going to start off with accounting for income taxes, but then we will cover accounting for pensions and post-retirement benefits. The case study? It'll be a case study. So it's just going to be a 1-pager that I'm going to ask for specific information on a company, and you guys will give me I'll post it before, I should be able to post it by next week. So you have it ahead of time, but it's not due till the end of the class. It's a case study. You didn't do any case studies in Intermediate Accounting 1 or 2? For your professors? Okay. It's not difficult. It's very simple with my case studies. It's just to incorporate, sections of what we're learning in the class. So like I was saying, week 2 we'll cover pensions and post-retirement benefits. Week 3 we'll do accounting for leases. Week 5, so week 4 that we will not learn anything new. We'll just use that week for if you want to review and for the midterm, and then we'll jump to week 5, accounting for changes in error analysis. Week 6, statement of cash flows, which you've done in Intermediate Accounting 1. So this would just go a little bit more into detail, but it's a lot of a refresher. And week 7, we'll talk about full disclosure and financial reporting, which is pretty much a summary of all 3 intermediate accountings together. So a final full disclosure statement. And like I said, and then week 8, we'll have the final. Any questions? Okay. So my grading criteria, like I said, we'll have every week a weekly assignment. You have your midterm and your final. The course project will be the case study. and participation, that is pretty much, you come to class, you participate, you're off the bat, you get your 10%.
Cuando yo la uso. El grabador de cada derecho. Cuando te sale el grabador, no la derecha, y no me queda. De la fuente de agua. Abre la fuente de agua y no va a pasar la derecha.
You're waiting for someone?
No, it's not there.
Hi, how are you? No, don't worry, come in.
Oh my God. Pero hay otro patrón.
¿Sí? Don't worry. Before I start with the lecture, I just need to get names. So Sandra, I got that. Rainier, Carolyn, and Laura. Okay, I will try my hardest to remember names. I sometimes will mess up, so I'm sorry if I do. So just to get prepared, everyone was fine with intermediate accounting 1 and 2. They understood the major concepts before we jump into all this continuation of intermediate accounting 3. Everybody was fine with intermediate 1 and 2. Okay, I'm just asking to see like how slow or how fast I should go into, if I should jump into more details when we start things, or should I just, I don't want to make assumptions that you guys knew something from before. So anything, if I go a little too fast and there's something you don't understand, just stop me, ask questions, and I'll give you a refresher on anything you need. So today's class, like I said, we're going to talk about accounting for income taxes. If you recall from prior courses that you took, there is what's called GAAP and there's what's called income taxes. You can have two statements of financial statements on different bases. So all along you've been learning about GAAP. Today we're gonna talk about what's accounting for income taxes. So I'll give you a perfect example. Depreciation. Depreciation is calculated one way under GAAP and it's calculated a different way under tax. So you can have two different depreciation expense numbers on your financials depending what format you're using. So that is an example of the differences between GAAP and income taxes. So these are the different sections we're going to cover. First, we're going to talk about fundamentals of accounting for income taxes, and we're going to talk about future taxable amounts and deferred taxes, future deductible amounts and deferred taxes, and valuation allowances. So basically what that means is there's timing differences. When you're allowed to deduct an expense and when you have to pick something up for income. There's a difference for GAAP than there is for tax purposes. So that's what we'll discuss there. Additional considerations, we'll discuss the income statement presentation, specific differences, and tax rate considerations. Tax rate considerations are what tax rate you're going to pay on your net income. So 35%, 40%, that's what will be discussed there. We will then discuss accounting for net operating losses, loss carryback, loss carry forward. We're going to do a loss carryback example and a loss carry forward. Basically what happens is when you have losses at a corporate level, you can carry them forward to future year. You can take the deduction in a future year, or you can carry it back 2 years. That's what this section was.
The bottom just 2 years.
2 years. Yeah, I believe it's 20 years future. Correct, for tax purposes. And then finally, financial statement presentation. We'll show you how to report on your balance sheet, what note disclosures are required, income statement, and then the asset and liability method. So this is what we will discuss today. As every chapter, we have learning objectives. These are the 4 learning objectives today. Understanding the fundamentals of accounting for income taxes, identifying additional issues in accounting for income taxes, explaining the accounting for loss carryback and carry forwards, and the presentation of deferred income tax in your financial statements. So, corporations must file income tax returns following the guidelines developed by the IRS. It is important to note that we will be discussing corporations. There's a big difference on partnership taxes. So, corporations pay tax at the corporate level. Partnerships don't. Partnerships do not pay tax at the company level. They issue the profit to its investors, and the investors report the taxes, the income, on their personal tax return.
It's like the LLC.
Correct. Now, To get a little more complex, LLCs can be, you can decide whether you want to file it as a partnership or as an S corp. But that's now getting a little bit more into income tax classes, like income tax accounting, which you've taken that class already, the income tax class.
Yes, the basic.
So I'm sure you discussed the different forms of entities,
Not for
LLCs.
corporate.
Because usually
Just
they'll focus more on LLCs, which can be S corps or partnerships. But I want just to make reference that we will be discussing here today corporations, which are the entities that pay tax at the corporate level. Okay, these are like your C corps. Because GAAP and tax regulations differ in a number of ways, the amounts reported for the following will differ. So here you go. This is the two differences you have. You have GAAP and you have the IRS. So the IRS comes up with their own set of rules of how you prepare financial statements, and GAAP comes up with their own set of rules of how you come up with your income tax expense. There is a differentiation between the two. So what is usually on your profit and loss is on a GAAP basis. Your income tax payable is what you owe the IRS. Does that make sense? So you can have my income tax for the year is $30,000, but I really owe the IRS $15,000 because there's a book tax difference. There's differences between what GAAP is telling you owe and what the IRS says you owe because you have differences that they don't allow you. So they may allow you to deduct something, but they may say, you can't deduct that for taxes. So that's why you have these differences.
On the gap, you have to fix laws or
Correct.
gain.
So picture GAAP like a Bible, right? That all these accountants and all these regulators put together and tell you, this is what your financial statements need to look like. And then you have the IRC code, which is actually really a book that the IRS puts together that says, okay, well, you're not going to follow this. When you do your tax returns, you need to follow our rules. Exactly. Just for the tax return. Correct. And it gets complex because when you work for big corporations that report to the SEC as a regulator, you're required to work on GAAP. You have what's now, this is what we're learning, accounting for income taxes. You'll have what's called book tax differences. So that's where this comes into play, how to report for these differences. Okay? So exactly what I was just explaining. Financial statements versus tax return. There's always going to be a difference. You have what's called your pre-tax financial income, and then your taxable income, that's per your tax code. So pre-tax financial income is GAAP, which is where your income tax expense is, and then you have your taxable income per your tax code is your income tax payable. Okay? So let's start with an example. Chelsea Inc. reported revenues of $130,000 and expenses of $60,000 in each of its first 3 years of operations. I'm going to just write this here. Actually, this board is bigger than my last board. So we have revenues, 130, and expenses, $60,000 in each of its first 3 years. So for tax purposes, Chelsea reported the same expenses to the IRS in each of its years. So listen to what it says when it reported to the IRS. Chelsea reported taxable revenues of $100,000 in 2017. The reason I write this is when I move on to the next slide, I always find myself having to jump back slides, so this way I don't have to be jumping back in slides. So I write all the facts down. So in 2017, $100,000. 2018, $150,000. And 2019, $140,000. What is the effect of the accounts of the reporting differences of revenue for GAAP versus tax? So do you see how here we're reporting 130 for GAAP, but here for tax we're reporting 100, 150, and 140. So which is our book, 130, 130, 130, 60, 60, 60. You have your pre-tax financial income of 70,000, income tax expense at 40%, and this is just an assumption. Everyone has a different tax rate, but they just assume the highest tax rate for our example. So for GAAP reporting purposes, your income tax expense is 28,000, 28,000, and 28,000 for 3 years.
20,000 is the 40% of 70.
Correct. Correct. 40% of the 70 is your 28,000. However, for tax reporting, you had different sets of revenues. Your expenses were your same, but look at your taxable income, how it changes. So your income tax payable number is a different number. 16, 36, and 32. So this is exactly what I was explaining to you. You may owe the IRS a different amount than what's actually your income tax expense on your profit and loss statement. And then why do you have different revenues? There could be different GAAP reporting requirements on revenues than when you have for tax. And there's a million examples. You may be required if, for tax purposes, you might be on a cash basis where you only have to report the revenue when you collect it. But for GAAP, remember, you collect it when it's accrued. So that's why you may have differences in
The
revenues.
expenses are the same.
In this example, yes, but you could have instances where expenses are different, where you have what's called book tax differences. That's in,
But at the end of the day, the both are the same.
what do you mean do that?
Like the numbers at the end.
No. Your income tax expense, your income tax payable, no, they won't be the same. Okay? Correct. Now, if you work for a company whose profit and loss statement is not on a GAAP basis, because they don't have to report to the SEC and they don't have a GAAP requirement, then this wouldn't come into play. Your income tax expense would be your same number as your income tax payable. But that's very seldom that you don't see that, because usually all businesses go on a GAAP basis. Okay? Because even if you don't report to the SEC, a lot of times you get bank loans. Bank loans, the requirements are that you're on a GAAP basis. Almost everyone requires you to be on a GAAP basis. Okay? Only if you work for like a small company, they don't have to be on GAAP, so they'll just be on a tax basis to keep things simple. So, comparison, so here's your difference. Income tax expense, which is GAAP, versus your income tax payable, which is your IRS. Here's your difference. 12, 8, and 4 carrying over to the end of $0 are the differences accounted for in the financial statements. So in your reporting year, so these are the accounts that you're going to use, deferred tax liability, and we'll learn the difference between a deferred tax liability and a deferred tax asset as we continue going. But this is the account you're going to use for the net difference between your income tax expense and your income tax payable. And again, it's a timing difference. So on the first year, you're gonna have a deferred tax liability of $12,000, which is your difference here. In 2018, you'll have a deferred tax liability, which is reduced by the $8,000. And then in 2019, you'll have your deferred tax liability, which is reduced by the $4,000, netting down to 0. Because they're timing differences, what it is. Okay?
But you're in negative
I'm sorry?
parentheses on.
Yes, they're negative, correct. So you're netting out to 0 at the end. It's your difference. So these accounts right here, these are balance sheet accounts. Remember, your balance sheet accounts go up and down every year. Okay? It's not like your profit and loss statement that zeroes out to your retained earnings. So eventually it's going up and down, 0. So again, see, book tax differences.
Yeah, at the end, the same amount that increase is the same that have to be to reduce, no?
Correct.
Mhm.
That's correct.
Correct.
Yep, it's a balance sheet. Your balance sheet accounts are constantly moving. They continue to roll forward at the end, after every year it continues to roll forward. It's not like your profit and loss statement that you zero it out at the end of the year and you start back up at 0. So here's just continuing on to this problem. It's basically showing you what your financial statements are going to look like. Sorry. So here are, in this case, is the deferred tax liability, $12,000. income tax payable of 16,000, and your income tax expense of 28,000. That's of your 2017. So this is how it would get reported on your financial statements, all the transactions that took place. This is per GAAP, income tax expense, your tax expense for the IRS, and the net of the two goes as a deferred tax asset. So you know how every debit needs to have a credit? There's your journal entry. Your balance. Exactly. So we have been discussing what's called temporary differences. There's two types of differences that you could have. You can have a temporary difference and a permanent difference. We're going to focus on temporary differences because these are the most important ones. Your temporary differences usually affect these two accounts, either your deferred tax liability or a deferred tax asset. It depends, is it a liability to the business or is it money you're actually getting back? Then it would be a deferred tax asset. So a deferred temporary difference is the difference between the tax basis of, the tax basis of an asset or liability and its reported amount in the financial statements that will result in a taxable amount or deductible amount in the future years. Okay, so future taxable amounts, which are considered deferred tax liability, represent the increase in taxes payable in future years as a result of a taxable temporary difference existing at the end of the year. So basically what happens is you have an expense that you're not allowed to deduct today because it's timing difference, it's temporary. You can't deduct it today, but you're going to be able to deduct it in the future, right? So you are basically creating a deferred tax liability today because you're going to get the benefit of it in the future. So I'm going to give you an example. Let's just say you pay rent expense, but the IRS does not let you deduct that rent expense. Okay? So it becomes a future taxable event for you. You'll be able to get the deduction for it in the future. Does that make sense? Certain expenses you cannot deduct today, but it's temporary. That means you can deduct it in the future. So that's why it becomes temporary. Deferred tax asset represents the increase in taxables refunded or saved in future years as a result of a deductible temporary difference existing at the end of the current year. So you have deferred tax liabilities and deferred tax assets. Another example. In the same example we were just discussing, in Chelsea's situation, the only difference between the book and tax basis of the assets and liabilities relates to the accounts receivable that arose from revenue recognized for book purposes. Chelsea reports accounts receivable at $30,000 in December 31st, 2017, GAAP basis balance sheet. However, the receivable has a zero tax basis. So per your books, you have an AR of $30,000, but per your tax return, you have an AR of 0. So that means that you have, for your books, you have income of $30,000 that you don't have for your tax return. So it's considered a cumulative temporary difference. So your taxable income is lower than your pre-tax. So you see how it's lower because you don't have to pick up that $30,000 of income for tax purposes. So GAAP tells you you're plus $30,000 of income, or for tax, you have 0. So you don't have to pay taxes on that $30,000 of income for your tax return. When you file your tax return, let's pretend this was the only income you made for that year, right? On your GAAP financial statement, it's the only income. And for tax purposes, it's not income to you because the IRS has a special section in their code section that says that $30,000 is not taxable. So now for your GAAP statement, you have to report 40% tax of $30,000, but for tax, you don't report anything. You don't pay any taxes on that. But it's a temporary difference. That means at some point in the future, you have to pay tax on that $30,000. Starting to make sense to you? Because the rules are all different. GAAP has different rules than the IRS. Is what happens. So we continue. Taxable income lower than pre-tax financial income in 2017, 2018, future taxable amount. So look what it's doing. It's basically saying that 30,000 that you didn't have to pay tax in 17 got split up between 18 and 19. The IRS said 20,000 gets reported in 18 and you're going to pay your taxes here. And the remaining 10,000 will get picked up in 2019. So it's just a temporary difference. Eventually, you do end up paying the taxes on the full 30,000, but it's not in 2017. And that is what's considered temporary differences.
It has some advantage, you know, because I don't know if the same, but on 30,000, it has some percentage. Probably 20 and 10 is less percentage.
Correct.
No?
Correct, because businesses have different tax rates throughout the year. You're correct. You're absolutely correct.
Are there any reasons that you don't, it's not taxable on the same year?
It's the IRS law. It's whatever their law is. Yeah, there's different regulators that create all these laws. GAAP has their own set of books of rules, and IRS has their own set of rules.
Because probably it should be.
And it's not only that. Remember, when you're doing GAAP financial statements, you have different end users, a different goal in mind. So people that are putting these GAAP rules together are so that investors don't get fooled, bankers don't, so we don't have economic crisis, so people can't lie through financial statements. The IRS is completely different. The IRS doesn't care who the end user is. All they care about is that people are not finding loopholes to not pay taxes. So they come up with their own rules that say, okay, great, GAAP says you can do this, but you still have to pay us taxes, so you have to do this. And that's what depreciate. I'll tell you right now, depreciation is a perfect example. GAAP lets you do whatever they on their set of rules for depreciation, and the IRS says, no, you can't take all this depreciation and not pay taxes. We're only gonna let you take this much this year, and this much this year, and this much this year, and that's why you have those book tax differences on depreciation. That's one of a perfect example. But there's a lot of complicated rules. When you start doing more complex income tax classes, you'll start learning the difference between GAAP and tax. And again, it depends what route in your career you're going to go. Are you going to do more on the GAAP route, or are you going to do more on the income tax side? I did income taxes. So I was not, if you ask me all the specific rules on GAAP, I don't know them off the top of my head because I didn't do this every day. But you ask me rules on tax, and I can tell you that's deductible, that's not deductible, this you have to pick up an income, this you, because you start learning all the IRS rules. So basically, we're still taking an intermediate accounting class, which is still related to GAAP. Well, GAAP had to come out with a way for end users to read these reports and really understand what is the tax effect on your financial statements. And it's never just looking at your GAAP P&L and saying, okay, great, we made $100,000, it's 40% tax rate, $40,000 is my tax liability. The answer is no, because there's all these differences that take place. So this is just trying to explain to you the temporary differences and what's the reversal of a temporary difference. 30,000 of income that you don't need to pick up for tax purposes, but then you're going to pick it up in 18 and in 19. They're called temporary differences. Now, I'm sure we'll get to some slides that talk about permanent differences, but if we don't, permanent difference are differences that never reverse. If considered a permanent difference, you can never deduct it, period. That's what permanent differences are. These are temporary because they eventually reverse. So, deferred tax liability represents the increase in taxes payable in future years as a result of a taxable temporary differences existing at the end of the current year. So this was the same example we just did, where you have income tax expense and income tax payable. The difference between the two is your deferred tax liability. Now remember, deferred tax liability goes in the liability section of your balance sheet. Deferred tax asset will go up in the asset section of your balance sheet. So do two different placements. One's a receivable and one's a payable. And super easy. Liability knows a payable. Assets are receivable. So that's where we'll be reporting. Just like that. But you're deferring it. Think about it. You're deferring it today. you don't have to pay this liability today. It's a liability to pay in the future. Okay, and the same way with the deferred tax asset. You will eventually get the benefit and it will be a receivable to you. Because it's the first year of operations for Chelsea, there is no deferred tax liability at the beginning of the year. So this is basically what's going to explain to you is what I was saying. Deferred tax or balance sheet accounts have a beginning balance. Remember your T accounts that you learned in your classes? Increases, and you have increases, and you have your ending balances. So usually, your deferred tax liability account will have a beginning balance. You'll have a beginning balance number, and you'll either go up or down, and you'll end up in your ending balance, right? Basically, what this problem is saying that is because it was its first year, the business just, the first year it started, its beginning balance was 0. So it says, your deferred tax liability at the end of 17 was $12,000. So your deferred tax expense for 2017 was $12,000. Your current tax expense for 17 is 16. So your income tax expense is $28,000. That is still continuing on for the problem we were doing. So here's your ending balance of your deferred tax liability account, the $12,000. If I just jump really quickly back, I'm going to jump back so you guys can see where these numbers came from as a refresher. So 28,000 income tax expense right there. This is 28,000. Your 16 of your tax payable is this 16,000. The net difference of the two is your deferred tax liability. Okay? And in this case, since we had a 0 balance at the beginning of the year, that's how this all formulates into each other. So now it's going to show you how to do the journal entry to record at the end of 2017. So you're going to debit your income tax expense, $28,000. You're going to credit your income tax payable for $16,000. And usually your plug for your entry is right here. You're going to have a credit to deferred tax liability. So the increase is a debit, so we're increasing the expense. A credit, we're increasing our payable. And a deferred tax liability, we're increasing right here. That make sense? And now again, this and this will continue going up and down every single year because your balance sheet accounts. What happens at the end of the year? This just zeroes out and you start all over again from the beginning of the year. So you're going to then go into 2018, right? And you would start your entry all over again. This will stay the same as 28,000 because it's your income tax expense for 2018. Now, if your income tax payable has to be, and I think the problem continues, if your income tax payable has to be $36,000, you're going to take the net between your 16 and your 36, because this means that at the end of the year, this is where your income tax payable account needs to be. But remember, this doesn't zero out at the end of the year. So you're going to have to take the net difference to get your income tax payable account to be $36,000, which will be $20,000 will be your net change. Let me see if the problem continues. It does. Oh, they do it through the deferred tax liability, so I'm going to take that back. So income tax expense, $28,000. Same here. Your income tax payable of $36,000. You're taking the net into your deferred tax liability account. Correct. Because no, it's going to be the net, the difference of these two. Correct. The difference of that too. Because what's going to happen now is your deferred tax liability started at $16,000. So we go to your T account. started off at 16,000 as a credit balance. So now you're gonna debit 8,000 here, which is journal entry. On the next one, we're gonna debit, we'll get to that one here. And this will end up at 0. You see? Now we did another debit here to your deferred tax liability account, which ends you up at 0. So your T account ends up at 0. So every year, your income tax expense is still the same as up here, because these accounts zero out at the end of the year, and you still have to record the income tax expense for that current year.
The income tax payable, it has changed. Oh,
Your deferred tax liability is the one that you're netting to get, think of it as your plug in your journal entry. You're gonna know what your income tax expense account is, you're gonna know what your income tax payable account's gonna
and
be.
the difference.
The difference is your deferred tax liability.
The account you put on the debit, for example, 28, on the credit 32, and the difference. It go to the credit, the rest, no, the missing.
Exactly. And your T account ends up at 0. So there's this. Oh, because I made a mistake, I'm sorry. I just, it's 12, you're right. How was it? Yeah, they were all here. I'm sorry, I took the 16 from the number right above. I meant to put the 12 in the bottom. So that gives you to the 0. So see, the entry to record income tax at the end of 2019 reduces the deferred tax liability by 4,000. The deferred tax liability account appears as follows at the end of 19. You go to your financial statements, you have your income taxes payable, your deferred tax liability accounts, and then your net income in the bottom. Income before taxes, income before income taxes, income tax expense, and your net income. So this is just on your P&L. And this is on a GAAP basis. This is your GAAP P&L. So for your GAAP, you have net income, your income tax expense, and this is what you're owing the IRS, 16, 36, and 32. Good? This is another illustration of what your P&L would look like. So income before income tax is 70,000, income tax, your current portion, your deferred equals your 28,000, and then gets to your net income 42,000. So this is just breaking up on the income tax expense. So total 28, what's current and what's deferred. And this, obviously we know this from the deferred tax liability account at the beginning of the year. So Starfleet Corporation has one temporary difference. So we're only going to talk one temporary difference. At the end of 17, that will reverse and cause taxable amounts of 55 in 18, 16, 19, and 75 in 2020. So it's saying when it reverses, there's not going to be income of these amounts. Starfleet's pre-tax financial income for 2017 is 400,000, and the tax rate is 30% for all years. There are no deferred tax assets at the beginning of 17. So let's just write all our facts down. Okay, so 2018. 55,000. 2019, 60,000. 2020, 75,000. They're saying it's pre-tax financial income, so that's its book income. It's 400,000. Tax rate is 30%. And deferred tax asset at the beginning is 0. Here. Those are artifacts. So it says, compute taxable income and income tax payable for 2017, and then to prepare the journal entry, to record the journal entry to record income tax expense, deferred income taxes, and income taxes payable. So the first thing we're gonna do is we already know what our pre-tax financial income is, which is 400,000. We need to pick up the additional income in each of the years. That's gonna be your taxable income. So in year one, we're gonna pick up the additional 55 on top of the 4, 60 in 2019, and 75 in 2020. So you see how we start picking up the additional income in each year?
Mhm.
This is now what's called your taxable income, because we start off with our book income, which is our GAAP income, and we're trying to get to what's our taxable income after our temporary differences. Our tax rate of 30%, this is going to be your income tax payable at the end of each year that you need to come up with.
With 190 and 210, where
So this 190 is the sum of these 3 years, which is that one temporary difference that the problem says it's reversing in the next 3 years. So that means if it's reversing, that means you didn't have to pay income on that on year one. So your first year, you only had to pay taxes on $210,000 of income. You see? Instead of on the 40%. Had this just been book, then you would calculate that 30% off of the 400,000.
210
Sorry?
what is it, 210?
Is the 400 minus the 190. So you see, instead of paying the 30% in the first year, you're allocating it across the different years when you're going to pay the tax on it. That's what you're doing. So the first year, your tax rate is only on the 210, and then you start allocating. So if you sum up these 3 amounts, that's what gives you that 210.
On the bottom.
So this is the sum of, so this 63,000 is 30% of 210. So you're gonna pay $63,000 of tax in 2017. You're gonna pay $16,518, $18,000 in 19, and $22,500 in 2020. So instead of paying all of this in one shot in 17, you're breaking it out within the different years. You're deferring it when you have to pay it. So this is considered a deferred tax liability because it's something you're gonna have to pay in future years. Is it starting to make sense now? Seeing the examples?
I'm struggling
Go ahead, ask your question.
because if you are all that, give you the 210.
No,
No. No, the sum of these give you the 190,
190, 400 minus 190 is 210.
is the 210. All you're doing is taking this 190 and allocating it out to separate years when you're gonna pay the tax on it.
You are not? 190 is the sum of the 3 years.
I know.
Correct, and then you're gonna take the tax rate off of each one of these years.
For the first year, that is 400.
No,
You did not want to know, ask, yeah.
No, ask a question. Sorry.
Ask the
because
question.
I don't know how to ask the question.
No,
No, I don't know. Es como, I see it in like, all those future years give you the 190, no?
So if you didn't have this temporary difference, let's pretend this temporary difference didn't exist in this company, right? and you had to go and file your tax return for your company, you would report this much income and you would pay taxes on this 400,000, right?
But
You
you
would file,
predict in 3 more years.
correct, but there's what's called temporary differences, book tax differences from what GAAP is and the IRS. So this is your book income, this is your taxable income for your IRS. So instead of paying tax on the full 400 on the first year, you're allocating that tax into separate years when you have to pay it. Because the government allows you to allocate it to different years
The company's allocated.
by GAAP, by the rules of GAAP. Correct. GAAP tells you when you have to report income and when you can deduct expenses. That's what you've been learning in all your other intermediate accounting classes.
And what about tax?
Tax, then you start learning as you go taking more tax classes when you're allowed to deduct and pick up income on certain things.
And they don't want to.
Correct. Correct. You're not expected to know that today. That's why these problems tell you what the temporary difference is going to be. I'm just taking a step further so you understand why there's these temporary differences. But the problem is telling you, you have a temporary difference of $190,000, which means you don't have to pay tax on that today. It's a deferred tax liability. You'll pay it in the future. So now you have income tax payable allocated across the different years and when you're required to pay it. Okay? So, your first year, you have your income tax expense of 120, where you're gonna debit, you're gonna credit your income tax payable of 63,000, and you have your deferred tax liability of 57,000. So the 57,000 of taxes that you have to pay in the future is your deferred tax liability account.
57 is the sum of the 3 years.
Of the future tax liabilities that you have to pay the IRS. So at some point in the future, you're gonna send the IRS a check for 16,500, 18,000, and 22,500.
When you first in the T account, to the right, that you know, 53 and 57. Oh,
Say it again?
in the T account,
Mm-hmm.
you first put the
Your T account for your deferred tax liability account. This is gonna
the
go
amount that you know
on
is
your,
57 and 63.
but this is a different T account. So you have two different T accounts, one for income tax payable and one for deferred tax liability.
That's my question. So how do you get the 120?
So this is just a plug of your two.
Okay.
So you see how it says there that's a plug? So you know what you owe your IRS at the end of 2017. Why? Because you came up with your taxable income and you took your tax rate. This is what you owe the IRS at the end of 2017. So that's why it goes into your income tax payable account. Okay?
And deferred
At some point, you will write a check for 2017 and pay that and send it to the IRS when you file your 17 taxes. You now know too that when you file your 18 taxes, your 19 taxes, and your 2020 taxes, you will have to write a check to the IRS.
But not only that, normally you have to pay 2% of $480,000 no matter what.
But at a future period.
Exactly.
Correct.
So that's how you get.
Correct.
the sum of the other two.
The sum of all
Like,
income.
The 30% of the full $400,000. Correct.
You only know the 63, that is the 1 year, and the 57, that is the sum of the other 3 years. And the difference on the sum for balance account is 120.
But what she's saying is that if you took 30% today of the 400,000, that's your 120,000. That at some point you're gonna have to pay the IRS the full amount. And it's just breaking it out here. When do you pay it? 2017 and future years.
Or 30% of 120?
Mm-hmm. So you're just allocating the different years of when you have to pay your taxes. And again, this is all because you're trying to put a financial statement so that people can read your financial statements and understand what your company is really doing. So they want you to know, yes, today you owe 63, but at some point in the future, you owe also $57,000. It's a deferred tax liability. Okay? Okay, future deductible amounts.
Todo viene igual, si no, algo está mal.
Sorry?
Tiene que cuadrarte todo, si no, todo algo está mal.
Exactly, that's the great thing about accounting.
Pero no como tú, ¿vale?
I don't know.
Well,
Here, that's why everything's very regulated, so you don't do things like that. Okay, so during 2017, Cunningham estimated its warranty costs related to the sale of microwave ovens to be $500,000 paid evenly over the next 2 years. For book purposes, so again, for GAAP, in 2017, Cunningham reported warranty expense in a related estimated liability for warranties of $500,000. In its financial, and $500,000 in its financial statements. For tax purposes, the warranty tax deduction is not allowed until paid. So here's another example of what the IRS allows versus what book allows. So your GAAP allows you to take an expense for $500,000, but the IRS says, no, you cannot take a $500,000 expense today for something that you're gonna pay in the future. You can only take it when you pay it in the future. In 2 years. Correct, in the 2 years, even. Okay, so you're only gonna take that deduction, allocate it over 2 years instead of the whole amount in 1 year. So exactly here we have another problem. 500,000 in year 1, 2018, 2019 split evenly, 250 and 250. Okay. So when Cunningham pays the warranty liability, it reports an expense, which is a deductible amount for tax purposes. Cunningham reports this future tax benefit in its December 31st, 2017 balance sheet as a deferred tax asset. So now it's a benefit to you. So because you get to take the deduction in the future year, it becomes a benefit. Because it's a benefit, it's a deferred tax asset. That means you will get the benefit in the future year. If it's a liability in the future, it's a deferred tax liability. Here it's a deferred tax asset because you get the deduction in the future year. So, a deferred tax asset represents the increase in taxes refundable in future years as a result of deductible temporary differences existing at the end of the current year. Hunt Company has revenues of $900,000 for both 17 and 18. It also has operating expenses of $400,000 for each of these years. In addition, Hunt accrues a loss and related liability of $50,000 for financial reporting purposes because of a pending litigation. So they're going to deduct $50,000 because of a litigation. However, they cannot deduct this amount for tax purposes until it is paid, which is expected in 2018. As a result, a deductible amount will occur in 2018 when Hunt settles the liability, causing taxable income to be lower than pre-tax financial information. So, write the numbers here.
It's 546.
So, 900. And then $50,000. 2018. So it's very deductible in 2018, and this is for 2017 and 2018. Okay, so you have the 900 in both years. You have your expenses of 400,000 in both years, and the 50,000 that they're accruing in 2017 for GAAP purposes. So you have your pre-tax financial income of 450 and 500 at 40%. So for GAAP purposes, this is your income tax expense, 180 and 200. However, for tax purposes, they don't allow you to deduct it until it's paid, in which case it got paid in 2018. So you can only take the write-off in 2018 for tax purposes. So you have 500 of a taxable income in 17 and 450 of taxable income in 2018 at 40%. Your income tax payable is 200 and 180. So you see the difference between the 2 years? What you have for GAAP versus what you have for tax. Okay? And again, your income tax expense is at GAAP. Your income tax payable is at tax. So HUN can compute the deferred tax asset by preparing a schedule that indicates that future deductible amounts due to deductible temporary differences. So 50,000 at your 40% tax rate, this is your deferred tax asset account, $20,000. So in the future, you're gonna get a benefit of $20,000. That's basically what it's your balance sheet is telling you when you have this account. So assuming that your tax asset at the beginning of the year is 0, this is your ending balance of 2017. Your deferred tax expense benefit of 20,000 is here. Your current tax expense for income tax payable is 200, and your income tax expense for GAAP is 180. So that's the difference. The difference between the two is your deferred tax asset. Same thing we just did for deferred tax liability, but we're doing it now for deferred tax asset. So you following that? Prepare the entry at the end of 17 to record the income taxes. So you have your 180 of income tax expense, your deferred tax asset of 20, and your income tax payable of 200,000. Okay. And then in 2018, you'll have your income tax expense of 200, deferred tax asset credited of 20,000, and income tax payable credited of 180. This is a representation on your financial statement. So on your balance sheet at the end of 17, your income tax payable account will be 200,000. At the end of 18, it'll be 180. Your deferred tax asset starts at 20, ends up at 0 at the end of 2018. Because it's all reversing, their timing differences. And then you have your income statement. So this is just presentation. And you have your T account. So this is exactly a problem similar to what we just did for deferred tax liability. We're going to do one now for deferred tax assets. So Columbia Corporation has one temporary difference at the end of 17 that will reverse and cause deductible amounts of 50, 65, and 40. So if you remember when we were doing the deferred tax liability example, it was additional income we had to pick up. In this case, it's an expense that we're able to get in the future. Columbia's pre-tax financial income for 17 is 200,000, and the tax rate is 34% for all years. There are no deferred tax assets at the beginning of 17. Columbia expects to be profitable in the future. So same situation as deferred tax liability. The only difference is here, we're going to have a deferred tax asset being debited as opposed to a deferred tax liability being credited. Okay, so you have your financial income of 200,000. Here are your temporary differences of the 155. So in this case, it's opposite. We don't get the deduction in 2017. You get the deduction in future years. Okay, so we're actually going to pay higher tax in year 1 than in the future years. So that's why it's a deferred tax asset. In the future, you're going to get the benefit of these deductions, of this tax advantage. So you have your income tax expense of 68,000, your deferred tax asset of 52,700, and your income tax payable of 120,700.
In the liability, you deduct the amount that to the first.
Your liability is when you have to pick up income in future years. In this case, deferred tax asset are deductions that you get in future years. Correct. So it's a tax advantage to you. Okay, that's why it's considered a deferred tax asset and not a deferred tax liability. Any questions? No? So deferred tax asset valuation allowance, a company should reduce a deferred tax asset by a valuation allowance if it's more than likely than not, it will not realize some portion of the deferred tax asset. more likely than not means a level of likelihood of at least slightly more than 50%. So if you don't believe, the business does not believe that they're ever gonna get the benefit of that tax asset, then you have to come up with a valuation account of what you think you would never get the benefit for. So companies can look out those future years and say, yeah, that's great that we calculated these amounts as a benefit for us in the future, but there's probably more than 50% chance that we're never gonna get that benefit. And they will come up with these estimations that are called valuation allowances to offset that deferred tax asset. It helps a financial statement reader really understand the financial statements when they know that they're really never gonna get that benefit. So Callaway Corp has a deferred tax asset balance of $150,000 at the end of 2017 due to a single cumulative temporary difference of $375. Okay, so they have a future benefit of $150 at the moment. At the end of 2018, the same temporary difference has increased to a cumulative amount of $500,000. Taxable income for 2018 is $850. The tax rate is 40. Excuse me. No valuation account is in existence. So at the moment, there is no valuation account. Assuming that it's more than likely than not that $30,000 of the deferred tax asset will not be realized. So they're basically saying out of this $500,000 of deferred tax asset that the company believes it's going to use in the future, there's a 50% more chance that the $30,000 will not be used. So now they're going to do a valuation account to offset that $30,000 against the deferred tax asset. So 725 is your book income. There are your temporary differences that the problem was giving you. So it's a cumulative 500,000. That's where that deferred tax asset's coming from. Your tax rate of 40% in 2017 gives you 150 of income tax, and in 2018 340, which ends up netting to 200,000. So income tax expense of 290. You're going to debit your deferred tax asset for 50 and your income tax payable of 340. So this is just your regular entries that we just learned. And here's where your valuation account comes. So in order to calculate the valuation, you're going to debit your income tax expense and you're going to credit your allowance for deferred tax asset. So you're basically saying that you're never going to use that $30,000. That's why you're picking it up as income tax expense. Good? On your balance sheet, as you've known from prior courses you've taken in intermediate accounting, a valuation account is always a contra asset to your asset account. So that's why it's considered a negative. So you have your deferred tax asset and you're going to back out that $30,000 that you're never going to use in the future. Okay, let's take like a 2-minute break before we jump into the next section. If anybody wants to use the restroom or drink water.